Welcome to a special Talk Tickers edition of the Deep Dive.
Glad to be here.
So our mission today is highly specific and honestly incredibly urgent. We are focusing entirely on the Q3 2026 earnings call from 8x8 Inc.
Right, ticker symbol EGHT.
Exactly. We have the raw earnings transcript right in front of us, plus the supplementary financial tables and management's direct answers from the Q&A session.
The whole package.
Yeah, the whole package. And the goal is to just cut through all the corporate jargon, pull out the most critical data points, and give you an actionable, really opinionated breakdown of what these numbers actually mean for a retail portfolio.
And we are tearing into a genuinely fascinating financial paradox today. I mean, usually when you evaluate a technology company, you want to see a few basic things.
Like revenue going up.
Right. Revenue climbing, debt disappearing, and gross margins as high as humanly possible.
Yeah, because higher margins basically mean you're keeping more pennies on the dollar before, paying the electric bill or the engineering team.
Exactly. But looking at 8x8 right now, we are seeing a management team actively cheering for their gross margins to go down.
Which sounds completely backwards.
It does. Wall Street usually punishes that kind of dynamic instantly. But we are going to explore why that dropping margin is actually, well, it's the loudest, most flashing bullish signal in this entire earnings report.
Okay, so we need to start straight out of the gate with the hard data.
Hit me.
We have to establish whether 8x8 passed or failed their Q3 report card before we can really analyze the mechanics of, how they pulled it off.
Oh.
Total revenue hit $185 million.
That is a solid number.
It is. That beats the high end of their own guidance by about $3 million, which represents a 3.4% increase year over year.
And context is key there. In a macro environment where enterprise tech spending has been just ruthlessly scrutinized by CFOs everywhere.
Oh, absolutely. Everyone is cutting budgets. So putting up a top-line beat of that magnitude is a massive indicator of core product resilience.
Yeah, and when you isolate their service revenue, which is really the absolute recurring lifeblood of any cloud communications provider, that number reached an all-time record.
Wait, an all-time record?
$179.7 million. So that's up 3.6% year over year.
Wow.
And this marks their third consecutive quarter of year-over-year service revenue growth. I mean, for a company that has spent the last few years navigating what has been a pretty grueling turnaround, 3 consecutive quarters of top-line growth is huge.
It signals the patient isn't just surviving, right? They are actively taking market share.
Exactly. But the real operating leverage shows up in the profitability metrics. So operating income landed at $21.7 million.
Which yields an 11.7% operating margin.
Right. And keep in mind, they originally guided for an operating margin sitting down between 9% and 10%.
So an 11.7% print absolutely crushes internal and external expectations.
It blows right past them. And fully diluted earnings per share came in at 12 cents, which beats guidance by a full 3 cents.
A 3-cent beat on fully diluted EPS. I mean, for a company operating in this specific market capitalization tier, that represents a massive influx of retained cash.
It really does. It means the company is capturing disproportionate value from every new dollar coming through the door.
They aren't just selling more software.
Right. They have fundamentally re-architected their cost structure. So the flow-through to the bottom line is highly magnified.
But, and here's the paradox we teased earlier, amidst all these record beats, gross margin actually dropped sequentially.
It did. It fell to 64.8%.
Yeah. A 64.8% gross margin drop feels totally contradictory when you place it next to record operating profits.
It really does.
For you as a retail investor, it's like bringing home a report card where you beat the curve in math, science, and history, but the teacher docks your overall GPA a full letter grade simply because, I don't know, your handwriting got a little sloppy.
That's a great way to put it.
Right. A retail investor sees a 64.8% gross margin in a software company and immediately starts looking for the exits, assuming pricing power has just collapsed.
And the CEO actually spent a significant portion of the call trying to decouple the market's mind from that legacy metric.
Because Wall Street has been conditioned for 2 decades to demand 80% gross margins from pure SaaS plays.
Exactly. Software as a service has always been about those fat 80% margins. But that legacy SaaS model relies on selling a company 1,000 user licenses, knowing full well that a huge portion of those employees will never even log into the system.
Right, the industry calls it shelfware.
Exactly.
You're just collecting rent on an empty apartment.
That's it. And selling shelfware carries an incredibly high gross margin because there is zero cost of goods sold on a software license that's just sitting dormant on a server somewhere.
Okay, so how does 8x8 fit into this?
Oh, 8x8 is aggressively restructuring its revenue mix away from that empty shelfware and toward usage-based offerings.
I see.
We are talking about communications platform as a service, commonly known as CPaaS digital channels, and AI solutions.
So customers are paying based on the actual volume of text messages they route.
Yes, or the API calls they trigger, or the AI tokens they consume.
Got it. You are routing real data across global telecommunications infrastructure.
Exactly. And there are hard network costs associated with every single one of those transactions. So naturally, the gross margin percentage on that specific revenue stream will be structurally lower.
But the genius of the model is the sheer volume, right?
Yes, the volume is where the magic happens.
Paying your software vendor based on usage is kind of like paying your water bill based on the gallons you consume, rather than paying a flat, massive monthly subscription just to have the pipes connected to your house.
That is exactly it. While the gross margin percentage is lower, the transaction volume is scaling so rapidly that the raw dollars of profit being generated are just exploding.
So once 8x8 covers their fixed engineering and administrative overhead, every incremental usage dollar drops straight down to that 11.7% operating margin.
Yes, and management actually pointed to competitors operating entirely in the pure usage-based space to illustrate this on the call.
Oh, really? Who did they mention?
Well, they didn't name names, but they pointed out that some of those companies run structurally lower gross margins, hovering down in the low 50s.
Wow, low 50s.
Yeah, but their operating margins remain highly lucrative. So the message to retail investors holding the EGHT ticker is clear.
Expect the gross margin to continue trending slightly downward.
Right, as usage-based products capture a larger share of the revenue pie. But as long as the total operating profit dollars keep climbing, the strategy is executing perfectly.
Okay, so understanding that the gross margin drop is a feature, not a bug, naturally points us toward the actual business drivers causing this massive shift.
And the numbers laid out in the transcript regarding their usage-based offerings are staggering.
I have them right here. Those products surged nearly 60% year over year.
Which is insane. Generating 60% growth on any product line right now is a heavy lift.
And those usage-based products now constitute 21% of their entire service revenue.
Climbing rapidly from the mid-teens just 12 months prior.
Right. So what's the catalyst driving that 60% explosion?
It's artificial intelligence, plain and simple. It is AI transitioning out of the laboratory phase and into the real world.
The numbers back that up. Customer contracts for 8x8's Intelligent Customer Assistant increased 70% year over year.
And the actual voice AI interactions spiked over 200%.
Over 200%.
Yeah. Voice AI now accounts for the vast majority of all AI interactions taking place across their platform.
I mean, think about it. 2 years ago, having an AI voice bot triage customer support calls felt highly experimental.
Totally. Customers were running isolated beta tests, terrified that technology would hallucinate and alienate their end users.
Oh yeah, making up fake return policies or hanging up on people.
Exactly. But today, AI is being deployed into production at full scale.
And the real-world examples they provided highlight how deeply integrated this technology is becoming.
Yeah, they detailed a massive win with a regional healthcare system employing over 850 people.
This healthcare network was running a highly competitive bidding process, actively evaluating 8x8 alongside heavyweights like Zoom and RingCentral.
And 8x8 won the contract not by simply undercutting on price, which is what usually happens,
Right.
but by acting as an embedded strategic partner. They put engineers on site, they brought in industry-matched healthcare references, and they deployed an AI bot capable of securely booking patient appointments.
24 hours a day, 7 days a week.
Exactly. The workflow transformation there is profound.
Because that single AI bot essentially absorbed the daily workload of 4 full-time human contact center agents.
It did. But here's the interesting part. Rather than simply firing those 4 people, the healthcare system was able to reallocate them.
Into more complex patient-facing roles, right?
Yes. Roles where human empathy and deep problem solving are actually required.
And they noted similar organizational transformations with a large veterinary and pet hospital company.
Right, who radically expanded their contact center capacity through disciplined weekly engagement with 8x8's leadership.
They also secured a massive expansion with an early education provider employing 43,000 people.
43,000 people. And they won that specifically because 8x8 offered a highly flexible operating expense model that aligned with the education provider's strict financial parameters.
So these aren't just standard software sales.
No, not at all. They are deeply complex architectural overhauls of how these companies operate their front lines.
But wait, there's a metric in the transcript that initially feels completely contradictory to this entire AI narrative. Booking medical appointments around the clock without human intervention. Shouldn't human contact center seat licenses be dropping off a cliff?
It seems like they should.
We have heard for 2 years that AI is going to trigger an apocalypse for human customer service agents. Yet, the CEO explicitly stated that human contact center seats are up quarter over quarter and up year over year.
I'm really glad you brought this up. He actually addressed that fear head on because it is the number one question institutional analysts are asking right now.
So why aren't the seats dropping?
The survival of the human agent really comes down to the fundamental difference between micro use cases and macro use cases.
Okay, unpack that for us.
Currently, AI absolutely dominates the micro interactions. For example, if you call your bank, the AI system uses your voice for biometric identification. Right?
Yeah.
It instantly retrieves your account balance, authenticates your identity, and maybe sends you an SMS link to pay a bill via Apple Pay.
And the entire transaction takes 30 seconds.
Exactly. And you never speak to a human being. The bot essentially acts as a highly efficient bouncer.
It filters out the lowest hanging fruit.
Yes. So the total volume of repetitive, mundane cases making it to a human agent absolutely plummets.
But the handle time, the actual minutes an agent spends on the phone with a customer, is going up.
Precisely. Because the only calls breaching that AI defense line are the highly nuanced multi-step problems that require negotiation, deep empathy, or complex troubleshooting.
So the bots are clearing the runway so the humans can do what humans do best.
That's it. And from 8x8's perspective, management is entirely agnostic to the delivery method.
They don't care if a customer buys more human seat licenses or more tokenized AI interactions.
Not at all. As long as the total revenue per customer increases and the stickiness of the platform improves, they are happy.
And right now, enterprise clients are aggressively buying more of both.
They are.
So while the AI adoption is this massive growth engine pulling the company forward, there is a second major driver from this quarter that is entirely focused on cleaning up the past.
Oh yes, the FUSC shutdown.
Exactly. On December 31st, 2025, 8x8 officially completed the decommissioning of their legacy US platform.
Which means every single active customer has now been migrated onto a single, modernized 8x8 architecture.
And the completion of this migration is a monumental operational milestone.
It really is. 8x8 acquired the USE platform several years ago. And over the ensuing years, those legacy USE customers generated over $300 million in cumulative revenue.
Wow, so it was a highly lucrative acquisition.
Very lucrative. It provided the necessary cash flow to survive a brutal macroeconomic downturn, aggressively pay down debt, and fund the R&D required to build their current AI suite.
But maintaining two separate code bases for that long must be an engineering nightmare.
Oh, it's terrible. It is the equivalent of owning two sprawling houses on opposite sides of the city.
Right. You were constantly paying two property tax bills, mowing two lawns, and repairing two roofs.
Exactly. Every time a new AI feature is developed, you have to build it twice to ensure it works on both platforms.
So forcing all the FUS customers to upgrade to the primary 8x8 platform instantly eliminates that duplicative complexity.
Yes. The amount of engineering talent that was tethered to simply keeping the legacy ESE servers operational was staggering.
So with the shutdown complete, 100% of that engineering energy is now liberated.
Completely liberated. They can point their entire development team exclusively toward growth, innovation, and just accelerating their product roadmap.
But management was very transparent that shutting down FUS created immediate intentional pain.
Oh, definitely. Because not every legacy customer wanted to undergo the friction of a software migration.
Right. Some of them inevitably churned, choosing to leave for competitors rather than upgrading to the modern platform.
And that intentional churn created a near-term revenue headwind in Q3.
And management noted it will continue to apply downward pressure into Q4 in the first half of fiscal 2027.
Yeah, they are willingly absorbing that short-term revenue hit to secure the long-term margin profile of a unified, highly efficient single platform.
It requires immense operational discipline to just rip the Band-Aid off and intentionally walk away from legacy revenue.
It does. But the resulting cost savings and engineering velocity far outweigh the temporary churn.
Okay, so they've absorbed the churn from killing the QSE platform, and they have this booming usage-based business driven by AI.
Right.
The obvious question for anyone holding this stock is, how do these mechanics impact the immediate future?
Looking at their Q4 projections, the guidance is undeniably strong.
Yeah, management is actively raising their Q4 revenue and operating margin guidance relative to what they had previously implied.
They're projecting total revenue for Q4 to land between $178.5 million and $183.5 million.
That represents a $7 million increase over the midpoint of their prior implied numbers.
And on the profitability side, fully diluted EPS is projected to land between 7 cents and 8 cents per share.
So the underlying momentum from Q3 is clearly carrying forward.
Definitely.
But there is one piece of the Q4 guidance that initially looks like a red flag.
I know exactly what you're going to say.
They just crushed their operating margin at 11.7% in Q3.
Right.
But for Q4, they are guiding for operating margin to dip back down to between 8.5% and 9.5%.
Yeah, that stands out.
For a retail investor, you see a drop of that magnitude, and you wonder if the 11.7% was just a fluke. Is this a structural crack in their pricing power?
It looks scary. But looking closely at the expense side of their ledger, this isn't a structural crack at all.
So what is it?
You see this massive, sudden spike in operating expenses projected right on January 1st.
Oh, right.
It's literally just the FICA payroll tax and 401k employer match calendar resetting to zero for the new calendar year.
Of course. Every single corporate employer gets hit with that exact same maximum tax burden in the first quarter of the calendar year.
Exactly. Throughout the year, as employees hit their compensation caps, the employer's tax burden on those specific salaries evaporates.
But on January 1st, the clock resets, creating a predictable temporary spike in operating expenses.
Yes. It has absolutely nothing to do with the business becoming less efficient.
It is simply the federal tax calendar doing what the tax calendar does every single January.
Furthermore, the revenue side of the equation faces a highly predictable seasonal headwind.
Right. Tell us about that.
The usage-based offerings, specifically the CPaaS APIs driving all those text messages and digital interactions, experience a significant volume dip in Q4 due to the major holidays across the Asia-Pacific region.
So businesses shut down, marketing campaigns pause.
Exactly, and the sheer volume of API calls temporarily drops.
But even with that known FICA tax spike, the Asia-Pacific holiday volume drop and a lingering $4.5 million quarter-over-quarter revenue headwind from the final wave of FUSI churn, they are still raising their overall guidance.
That is the amazing part. And the CFO detailed a fascinating dynamic regarding their current operational stance.
Because they have unified the platform and streamlined their overhead, they possess a natural hedge.
Yes. If they experience an unexpected headwind on top-line revenue, management has the levers to naturally compress their expense base in tandem.
Effectively neutralizing the impact on net profit.
Exactly. They are no longer completely at the mercy of macroeconomic demand shocks.
That level of agility brings us to the ultimate synthesis of this transcript.
The bottom line.
When you look at the past numbers, the mechanics of the AI usage boom, the strategic execution of the FUSI shutdown, and the forward guidance, the takeaway for a retail investor has to be definitively bullish.
I agree completely. While the explosive growth of AI handles the flashy headlines, the true foundation, providing an absolute floor for this stock, is their masterful execution of debt reduction.
The capital allocation strategy deployed here over the last 2 years is a masterclass in deleveraging.
It really is. Since August 2022, 8x8 has paid down $224 million in debt principal.
They wiped out 41% of their total outstanding debt load during one of the most punitive interest rate environments in modern history.
And by eliminating 41% of that principal, they effectively slashed their annualized interest expense by more than 50% compared to the second half of fiscal 2023.
Interest expense is just a parasitic drain on a company's income statement.
It provides zero strategic value. It funds zero research and development and builds zero customer loyalty.
It is simply a penalty for past borrowing.
Exactly. So by cutting that interest penalty in half, 8x8 permanently, structurally increased their net income.
Even if their top-line revenue stayed completely flat for the next 5 years, they would generate significantly more free cash flow every single quarter, simply because they are no longer handing millions of dollars to the bank.
It is the ultimate financial blow-up.
For you as an investor, looking at 8x8 right now is like looking at a homeowner who finally finished their massive, painfully expensive house renovation.
Which represents the integration and decommissioning of the USE platform.
Exactly. The moment the dust settled on the construction, they took all their extra cash flow and paid off their high-interest credit cards.
Which represents that 41% debt reduction.
Right. So now the house is in perfect order. There are no lingering construction projects draining resources. Their monthly interest payments are slashed in half, and every single new dollar of rent they collect drops straight to their bottom line.
And the rent they are collecting is compounding rapidly because their multi-product strategy is executing flawlessly at the top of the market.
Yeah, the CEO highlighted that all of their top 20 enterprise customers now utilize multiple 8x8 products.
The vast majority of them are deeply entrenched, using 3 or more distinct solutions.
And when a massive enterprise client deploys 3 separate products from the same vendor, they stop viewing 8x8 as a simple point solution that can be swapped out for a cheaper competitor over the weekend.
Exactly. 8x8 becomes an embedded strategic platform partner woven into the daily operations of the business.
And the financial metrics heavily incentivize this cross-selling strategy.
Right. On average, customers utilizing 3 or more products generate more than 3 times the revenue of a customer using only 2 products.
It is exponential revenue growth harvested directly from the existing customer base, requiring significantly lower customer acquisition costs than hunting for net new logos in a crowded market.
They are running the classic land and expand software playbook, and they are doing it with their largest, most lucrative enterprise clients.
So for a retail investor evaluating the EGHT ticker, this transcript outlines a highly successful turnaround story that has officially transitioned into a sustainable growth phase.
The management team survived the grueling technical integration of FuseE, ruthlessly repaired their balance sheet, and pivoted back to top-line growth.
If you believe the broader enterprise software industry's shift toward pay-as-you-go, usage-based AI is a permanent structural evolution, 8x8 has positioned its entirely unified platform ahead of the curve.
More importantly, they have proven they can generate real, tangible cash flow while scaling this new architecture.
Right. This is not a speculative tech company burning through venture capital on AI dreams.
No, this is a highly profitable, deleveraged business utilizing AI to drive highly scalable, usage-based profit margins.
Which is exactly the profile you are looking for when stress testing a tech portfolio in 2026. Taking the time to understand the operational mechanics underneath these numbers, like how tokenized pricing fundamentally alters the gross margin profile, or how FICA seasonality impacts quarterly operating leverage, is what separates informed capital allocators from investors blindly reacting to legacy metrics.
Because knowledge only becomes an advantage when it is deeply understood and applied to the underlying mechanics of the business, rather than just reading the top-line summary.
Well said. Before we wrap up this deep dive, there's one final, broader market question worth pondering as you review your own portfolio.
I love this part.
During the Q&A, CEO Samuel Wilson described a massive industry-wide paradigm shift away from pure SaaS subscriptions toward hybrid and tokenized pay-as-you-go models.
Right, he argued this is accelerating because it fundamentally transfers risk away from the buyer.
Enterprise clients are tired of paying for software they don't use.
They only want to pay for what actually works.
Exactly. So if this usage-based tokenized pricing model becomes the permanent gold standard across the entire technology sector, which legacy software companies in your portfolio are still entirely reliant on selling empty shelfware?
That is a scary thought for some of those legacy giants.
And what happens to their valuation when their customers inevitably demand to only pay for the exact data they consume?
It represents a profound shift in leverage from the software vendor back to the enterprise customer. And a significant portion of legacy tech companies do not have the architectural flexibility to survive that transition without destroying their margins.
The old SaaS models were clean, binary, and predictable.
But the future is usage-based.
It is driven by AI volume, and the financial metrics are going to look incredibly murky until you learn how to read the new architectural blueprints.
Spot on.
Keep diving deep, stay curious, and we will catch you on the next deep dive.